Thank you for joining me. I'm Gord Long. A reminder before we begin, do not trade from any of these slides. They are commentary for educational and discussion purposes only. Always consult a professional financial advisor before making any investment decisions. The purpose of the audio slides is to talk about the areas that are not updated in your monthly analytics and technical analysis report. This is based on our annual cycle, as outlined on the subscriptions page on our site. We intentionally keep the technical analysis charts to the subscriber reports so as not to confuse them with the drivers operating behind them. Drivers in the long term are primarily the fundamentals, in the intermediate term risk, and in the short term it's about confidence and sentiment. This month I'd like to consider just how the next market correction might unfold and what to watch for as the key drivers behind it. As such, I would therefore like to cover the following subjects. To understand the insanity we are presently witnessing, we need to take a step back and consider just how institutional money, like pensions, insurance companies, and financial intermediaries think. One, they like fixed income because it's far less volatile and ostensibly less risky than equities. Two, they hate small caps and frankly can't invest in them due to their size, and they have a disdain for commodity markets. That volatility thing again. Volatility is like a barometer in their world by which everything else is measured. The problem is with the central bank's untested interest rate policies of QE, QQE, ZIRP, NIRP, and Operation Twist, etc., none of the institutions have been able to make sufficient money without accepting too high a risk-reward profile. So what are they doing in a yield-starved world? Wait for it, they're selling volatility. They are doing this either through tailor-made products from the investment banks or by buying any number of the low volatility exchange-traded products, ETPs, out there. Volatility isn't even an asset or an asset class. It appears to be becoming one. The hard reality is that the VIX is an index of volatility on 1 month to expiry ATM puts and calls on stocks in the S&P 500. Over the last 3 years, the geniuses on Wall Street have figured that they can actually package this animal, which as you can see is really a derivative of a derivative, which is then treated like a bond. I am reminded of a similar illusion in the run-up to the 2008 crisis where credit default swaps, CDSs, were used to transform high-risk junk debt into acceptable AAA institutional debt instruments. Frankly, hats off to the asset managers who had the creativity, courage, and chutzpah to do this. They believed in the central bank's liquidity machine, and they backed their belief, and for that they deserve to be paid. However, it doesn't make it even close to a sound investment strategy. What we do know is that this entire game of the selling of volatility via passive indexing is that all of it is predicated on one thing: central banks keeping rates low and pumping liquidity into the market. It's why buying the dips has become the meme. Problem that I have with it, other than the many distortions, endless distortions frankly, caused by it, is that when so many are on one side of the boat as they now are, with that boat having many moving pieces, then I get nervous and I look for a lifeboat just in case. I am reminded that markets change at the margin, where the slightest hiccup can act like a spark to light the fire of volatility, and these poor institutions who've managed to earn steady income selling puts find out what unlimited risk actually looks like as they are forced to cover in markets that are gapping the other way against them. The old-time institutional players, frankly, have retired. They're being managed by people in their 20s and early 30s who have never really seen the kinds of problems that can unfold like this. We saw in 2000, some of us can remember 1987. While asset valuations are not at life extremes, the reality is that volatility itself is. In 2017, the Dow traded in a 110-year record-tight trading range. The VIX hit all-time lows, and U.S. equities reversed from sell-offs at near their fastest pace in 90 years. Institutions and increasingly private investors no longer fear risk, but actually love it, as it's another opportunity to harvest what is now referred to as dip alpha. Volatility across asset classes has decoupled from uncertainty. Even if seemingly irrational, apathy to all risk has been the right trade and an impossible trend for most to fight. Frankly, the definition of a bubble. But as the classic and generally reliable ending diagonal shown here suggests, it may not last too much longer. According to the Bank of America Merrill Lynch's derivatives expert Benjamin Bowler, and I quote, "While there is active debate about whether risk assets like equities and credit are overvalued, it is much harder to argue that currently depressed volatility levels are unsustainable when near 100-year records in terms of low volatility and the lack of persistence of any shock are being recorded." As shown here, the VIX is near 26-year lows, despite political and policy uncertainty recently near 26-year highs. What is not fully recognized is that 90-year records are occurring in the speed which U.S. equities are recovering from any and all dips, as few as they are actually becoming, that is, the dips. What is happening is volatility, as I said, is being sold. Over the last 6 months, VIX has spent more than 40 days below 10. Putting this staggering outlier in context, the index has never managed to accumulate more than 6 days that low, measured over the same time interval over the last 30 years. I recently read, and I quote, "Why buy volatility if you believe that any sell-off is impeded by a central bank backstop?" End of quote. In fact, as we get into it in a moment, implied volatility is sailing in the same uncharted waters as corporate credit. Let me lay out, as graphically shown here, a roadmap for our discussion. First, let's talk further on what is driving extreme low volatility in such turbulent times, then discuss corporate credit via the junk bonds, then margin and leverage, and finally tie them together with some observations on the explosion in passive ETFs. I suspect this will be the roadmap of what is in store for us going forward during the inevitable coming market correction, or minimally consolidation if you believe markets are headed higher. A little history may be in order. My observations, which the Bank of America Merrill Lynch recently graphically annotated in this chart, are 1. Investors' reaction to the Fed announcements of plans to slowly stop QE in July 2013 resulted in the market's taper tantrum and forced the reaction of coordinated G4 central bank intervention. The 4 central banks I often refer to as the currency cartel, the Fed, the ECB, BOJ, and BOE, Bank of England, which control 95% of current daily currency trading. In August 2015, China shocked the market with a currency devaluation which led to the Shanghai Accord, which I did a number of videos on at the time, where Fed Governor Janet Yellen decided, or was forced, not to raise rates due to what she then publicly articulated, at least, as due to, quote, weak equities, when they were only down approximately 10%, as I recall, from all-time highs at that point. Subsequently, when the Brexit vote shocked the markets in June 2016, it marked the inflection point when the buy the dip trade became a self-fulfilling put, since Yellen signaled she would move more slowly with rate hikes because of the Brexit fallout concerns. Bank of America Merrill Lynch cited the same observation and referred to it as the initiation of the dip alpha program trading that I mentioned previously. All of this resulted in a Fed put strike price. But what is the Fed's put strike price now? What we know is that we have an untested strike price, as buy the dip buying is assuming the Fed will step in. The strike price is falling as Fed raises rates and rebuilds ammunition, and as a consequence, the Fed will accept more risk as it recognizes the markets can better stand on their own. The Fed and central bankers need a shock to test what is it now. That is, what is the strike price here, at least from a market perception. In this world of record high valuations and record low volatility, in which the market no longer responds to new shocks or risk, and in which nobody dares to point out the obvious, that this is the biggest asset bubble in history, there seems to be just one trade: low risk premia, low levels of volatility, lack of responsiveness to tail risks, spillover of systemic events, the reluctance to sell, extreme valuations. But they're merely symptoms. The central question is, what are the skewed incentive structures resulting from this Fed backstop doing to the fabric of markets after so many years? It appears that the trades and strategies which explicitly or implicitly rely on low volatility environment continuing have become and are becoming more and more ubiquitous. This graphic is a representation of how Citigroup Research presently sees what is going on in this self-reinforcing trading pattern. In a world without market shocks, volatility continues to decline, forcing even more volatility selling in a self-reinforcing feedback loop. Low volatility means falling value at risk and rising Sharpe ratios. These foster higher risk limits for institutions. More inflows accept risky assets. In the way of clarifications, for those that may not be familiar, VAR, value at risk, is a statistical technique broadly used by financial institutions to measure and quantify the level of financial risk within a firm or investment portfolio over a specific time frame. VAR calculations can be applied to specific positions or portfolios as a whole to measure firm-wide risk exposure. The Sharpe ratio is the average return earned in excess of the risk-free rate per unit of volatility, or total risk. Subtracting the risk-free rate from the mean return, then the performance associated with risk-taking activities can be isolated. This is what drives institutional thinking. Frankly, clever to the point of being stupid. The immediate result of this dynamic has been basically twofold. Investors now buy every dip, or as the Bank of America notes, investors no longer fear shocks, but love them, as it has an opportunity to predictably generate alpha, end of quote. And two, selling of volatility has become a self-reinforcing dynamic in which lower VIX begets more volatility selling by yield-starved investors, leading to even lower VIX as the shock that can reset the feedback loop is no longer possible, and thus the strike price on the Fed put cannot be put to a market test. We are likely on autopilot until the inevitable shock hits, and it will. There is a clear risk that the 2017 low volatility environment carries on through 2018, which is more likely if inflation were to fail to rise, prolonging the current Goldilocks period. The Fed could continue to slowly plod along with hikes, and absent a sufficient exogenous shock, the market may maintain full faith that they could pause or cut if needed. Equities would again generate exceptional Sharpe ratios, beating almost any other assets, as we saw this year, as U.S. equities recorded nearly their highest Sharpe ratios in history this year. The Dow Jones Industrial recorded a Sharpe of 499 percentile since 1935. The chance of this repeating yet again may be lower than some expect. The key driver of this market is central bank asset purchases. Trades and strategies have been built up around an assumption of the status quo. The inflection point, if and when it comes, will be anything but smooth and linear. The longer we remain in the current paradigm, the greater the chance that it ends up being both sharp and painful. A wise man observed, I once read, and I quote, "In economics, things take longer to happen than you think they will, and then they happen faster than you thought they could." Markets and trading strategies have not factored in the major central banks' plans for nominalization in the United States, taper in the EU, nor tightening in Japan, that is via reduced ETF purchases they're talking about, or tightening in China via crackdowns on the shadow bank lending. To a large extent, as the yield curve itself reflects, institutional investors simply don't believe the central banks will follow through, and an aging business and credit cycle are really the controllers to watch, not the central banks jawboning. The central banks I believe, they're losing control. They will probably be forced to go further than most can appreciate because besides the yield curve Even key indicators like the Financial Conditions Index are going the wrong way or simply not paying attention to the central bank's jawboning. Potential shocks are endless, the highest probably being inflation, the central bank's liquidity restrictions that they're announcing, a possible war in whatever form it might take, presidential impeachment, and therefore a retracement of the Trump rally. The biggest vulnerabilities lies in the assumption of status quo, and markets have not reflected changes in the paradigm. Here's a list of 30 risks to the market that in 2018 that Deutsche Bank just recently put out. Let's move to corporate credit market for the sake of time, and specifically how high-yield corporate credit it plays into this. The desperate global search by institutions for yield has driven credit spreads to historical lows, levels usually occurring around or precipitating a crisis. I've never seen spreads this low with as many potential clearly evident market risks, our Deutsche Bank list of 30 as an example, which are not priced in and additionally could significantly change the spread dramatically. Headline risk is simply not a consideration anymore. We have dumb money blindly following or being forced to follow the herd. There is little question from a timing standpoint. We are long overdue for some sort of violent adjustment. Identifying what it will be is really a fool's mission. It's basically irrelevant. Only the probability of such an event occurring needs to be assessed at this point. Remember, when it occurs, you will not have time to exit. It is my opinion, and we'll get into that. Liquidity will at that moment disappear in a heartbeat. I've seen this many times before. That takes us to the margin debt and leverage supporting all this. Margin debt growth on the New York Stock Exchange is now outstripping the S&P 500 growth. This is highly unusual and certainly has never been sustained for any period of time, especially when margin debt net credit balances are so historically low. The 2% danger signal was something Alan Newman at Cross Currents concocted many years ago after seeing total margin debt peak around 2% of market cap in 1987, just before the crash. Since then, or since specifically 2010, every year has been above the 2% level. More importantly, he began to measure total margin debt versus GDP during the tech mania. And he believes, and he shows, it is a vastly more significant measure, better able to detect periods of excess leverage, and you can see where we're at now. Personally, I think this graphic puts the excess leverage into perspective. Total system leverage, government, corporations, household, margin, banks, is clearly driving the lift in stock prices. As our recent Under the Lens video addressed, how good is the underlying collateral supporting this credit edifice? That's what's missing in everything I've shown here today, but well laid out in this the recent Under the Lens video. Finally, for the sake of time, let's talk about passive ETF growth. This itself is a huge discussion, which I am going to have to leave in total for another day. Suffice it to say that global institutional pension fund assets in 22 major markets stood at US $36.4 trillion at the year-end 2016, amounting to 62% of global GDP. That is a staggering large amount of money. Pensions and institutional funds are big, cumbersome, dumb money, and they're all now, more and more, allocated in equally dumb indexes, passive strategies, and bonds. The passive bubble is growing bigger as I write this because this beast is fueled not just by Wall Street, but increasingly by the average investor getting back into the market as they are afraid of missing out. Consider this recent New York Times article headlines. Quote, "Signs of the peak. Former Target store manager makes millions day trading volatility from his bedroom." You always get these sort of headlines as market tops approach. Bloomberg just ran a piece. BlackRock and Vanguard are less than a decade away from managing $20 trillion. Two towers of power are dominating the future of investing. Dominating indeed. Here's how come the Wall Street crowd can afford Tom Ford suits. The article suggests investors from individuals to large institutions, such as pension and hedge funds, have flocked to this duo, won over in part by their low-cost funds and breadths of offering. The proliferation of exchange-traded funds is supercharging these firms and will likely continue to do so. End of quote. These behemoths don't do battle in the little unloved sectors or with stocks that don't make it into an index. They can't because they're too big. Everything about ETFs is about some form of index. Here's the competition in active versus passive funds. Right now, it's a mosh pit food fight to grab and create the next index or ETF so that more capital can be attracted, earning more fees, buying more suits. This is all well and good. Markets do what markets do, and I'm not here to grumble about it. I'm here to make money. And indeed, if I was in the passive business, I'd be enjoying the steady stream of fees and hoping like hell the market keeps going up. Quantitative easing? More. Yes, please. Stocks in the index funds no longer trade on fundamentals. Let me repeat that. Stocks in the index funds no longer trade on fundamentals, but rather on asset flows, which, by the way, sucks the oxygen out of the small guys who don't make it into the indexes where brain-dead passive money is playing. Ask yourself, what happens when pensioners start drawing down on their funds? The reality is global baby boomers are now retiring at approximately 10,000 per day in the U.S. alone. This is happening now. But like a slow-moving glacier, we can't see it. But it's happening, and it's going to happen, and it's going to change things like a snap of the last snowflake that starts an avalanche. Here's a typical ETF chart. This one is of Barclays High Yield Bond ETF. I've annotated it to show how it has been completely supported by central bank liquidity programs. It is hanging on by a thread as volumes are now slowing, as you can see in the bottom. When and if the fall comes, you can be assured it will be dramatic. This is a typical chart when I look through this entire ring that we just went through. I remember during the financial crisis when the Federal Money Market Fund broke the buck, corporate CFOs prudently began shifting money by the click of a mouse into short-term treasury bills. $5 trillion in one afternoon sent the U.S. Treasury Secretary Paulson and Fed Chairman Bernanke to the Congress that night in near and complete panic for closed-door sessions to see how they could literally save the world. The whole idea behind ETFs is diversification with ready liquidity. However, there's no liquidity, and the pricing of ETF products calculates that against you if you're able to exit. If you can't, and I see this to be the coming reality, it will be even worse than you can imagine and likely of historic consequences. This time, the clicking of mouse clicks won't just be CFOs. It'll be the public, fund managers, pension plan managers, etc. Where is the liquidity? Consider yourself warned. Nothing is going to happen when everyone pushes the button. You can be assured of that. As I often do, despite the negatives here, remember, when all this happens, they will print the money to solve any and all problems until such time as no one will take the money, or it is of no value, or it doesn't solve the problem. That day is still in the future, so take advantage of the opportunities as they currently exist. Investing is always easier when you know with relative certainty how the powers to be will react. Your chances of success go up dramatically. I would like to take a moment as a reminder, do not trade from any of these slides. They are for educational and discussion purposes only. Thank you for listening, and until next month, may 2017 have turned out to be an outstanding investment year for you and your family, and I thank you very much for listening this year.